Hello everyone and welcome to this episode of Ignition Time. Inflation is well above 8%. It's the highest it's been in the past 40 years. Yes, you heard that right. In fact, the risk of recession is now rising. This episode of Ignition Time is based on this article on your screen from the Wall Street Journal. As always, we'll provide you with a link to all of our resources in the description section below. The risk of recession is rising. In fact, forecasters say that the probability of an economic recession in the next 12 months is as high as 28%. Yes, you heard that right. Economists are saying that there's a growing risk of recession in the US economy. Even though our economy is strong, the Federal Reserve does have to raise interest rates to try and curtail inflation. In fact, a lot of economists surveyed by the Wall Street Journal said that the probability of a recession sometime in the next 12 months is as high as 28%. This is up from 18% in January and up from an estimate of 13% a year ago. According to Joe Brisolis, who's a chief economist at RSM US LLP, risk of a recession is rising due to the series of supply shocks cascading through the economy as the Fed lifts rates to address inflation. In fact, economists slashed their growth forecast this year and they think the economy is going to slow down and we're going to have a recession. Let's take a look at this image on your screen, which reflects the probability that the United States may be in a recession in the next 12 months, all the way leading up to today. And you can start to see that during the financial crisis in 2010, there was a very high risk. In fact, the risk of a recession was close to 100%. And now the risk of a recession has risen substantially. And what's the big reason, folks? The big reason is the alarmingly high inflation rate. And that means the Federal Reserve will need to raise interest rates in order to cool the economy down to bring back inflation. But they've got to do it in such a way that does not lead to a lot of pullback in spending and that does not lead to rising unemployment. And this is the extremely difficult balance that the Federal Reserve actually needs to strike. Now, this is important, folks. As the Federal Reserve raises interest rates, things slow down. It becomes much more expensive to borrow money for a car, to borrow money for a house. It becomes much more expensive for businesses to borrow money, which means they're less likely to want to grow, which also means that they're less likely to want to hire. Overall, whenever interest rates go up, the economy does cool down. Now, the trick is, can the Federal Reserve achieve their goal, which is to lower inflation without causing a slowdown of the economy, without leading to job losses? And that really is a really difficult part, the challenge, if you will, that the Federal Reserve is facing. Speaking of the Federal Reserve, let's take a look at the percentage of economists who say that a 50 basis point rate increase is expected in 2022. You can start to see that more and more people are now expecting that there will be 50 basis point increases in interest rates by the Federal Reserve. Now, the number of economists who think that there'll be 50 basis point hikes is 13.1%. The number of economists who think there will be 50 basis point hike is 29.5%. And this is interesting. Almost half of all economists think that there will be at least 50 basis point hikes this year. And by the way, what that means is when there's a 50 basis point hike, it means that instead of paying 3.25% for a mortgage, which by the way, those days are gone, mortgage rates are now in the mid fours. Let's say you were going to pay 4.5% to get a mortgage. Now the interest rate will go as high as 5%, maybe even 5.5%. And that could mean anywhere from $100 to several $100 a month in terms of your interest rate payment on your mortgage. Of course, that depends on the size of your mortgage. In fact, according to Amy Krukatz of AC Cutts and Associates, Amy expects higher, more persistent inflation than her peers because the main drivers are commodity prices, and all commodities have become more expensive because of Russia's war on Ukraine. And she said that even if the Federal Reserve acts, we may not see a reduction in inflation. And this is what Ms. Krukatz said. To be seen not fighting it is politically unwinnable, but the only policy response the Fed has is to tighten. Fed actions to curb inflation will lead to a recession sooner rather than later. And this is bad news, everyone, when you really think about the fact that we really need our economy to recover, but we need it to recover without derailing the economy. Here's a quote from Philip Murray, who's a senior US strategist at Rabobank. The Ukraine crisis will cause another boost to inflation in the near term, but the wage price spiral that has started already is a more permanent threat to price stability. In fact, in such a spiral, workers make more money, but they make more money to keep keep up with rising prices. And then those higher wages actually prompt their employers to raise prices on their customers more. So it's like this. Let's say you buy something from McDonald's. McDonald's has to pay higher wages to all their employees. And then in turn, McDonald's has to raise the price of the food that you buy. And that process, in fact, is already underway. You know that when you go and buy stuff, whether you buy stuff at McDonald's or any other place, or whether you go to the grocery store, you know exactly what I'm talking about. In fact, Robert Fry of Robert Fry Economics LLC said the chances of a recession in the next 12 months are a mere 15%, but he raises that to well over 50% in the coming 24 months, and he expects a recession that lasts 3 quarters, 9 months, to begin in the final quarter of 2023. He said this: the problem is really excess demand resulting from last year's fiscal and monetary policies. The longer the Fed waits to get inflation under control, the deeper the recession will be. And folks, that really is the big challenge facing the US economy. And here's where we are right now. A majority of economists, 63%, still think the Fed will be able to control inflation, to be able to reduce inflation without triggering a recession. And by the way, in economical terms, in financial terms, this is called a soft landing. Many of them think that the economy is well positioned to withstand the effects of high interest rates. And here's a quote from Leo Feller, who's a senior economist at the Anderson School of Management at the University of California. There is still a lot of pent-up demand and momentum in the economy. Higher interest rates may cut growth from about 4 to 5% to about 2 to 3% this year. So we'll see a significant slowdown in growth, but a recession seems unlikely at this time. Folks, all of this data was based on this Wall Street Journal survey that you see on your screen. This Wall Street Journal survey was done using 65 businesses and was conducted in the first week of April. Let me know whether you agree or disagree with this analysis and whether you think we are likely to see a recession, which, by the way, means less jobs, more unemployment, higher prices, and an overall sluggish economy. Or do you think we are likely to bounce back? I believe that we will not go through a recession, even though a lot of economists feel that that is the case, because I believe our economy is resilient. I also believe that the future of work involves one individual with multiple skills. You're not going to be doing one job from 9 to 5. You're probably going to be doing a bunch of different things. Let's take my own case, for example. During the day, I run my companies, I manage my investment portfolio, and in the afternoons, I make YouTube videos. By the way, I enjoy making these videos, so if you appreciate the effort, please click the like button, please click subscribe, please enable notifications. The way you can protect yourself against inflation is by enhancing your skill set and making sure that you have multiple ways of being productive and earning income. Thank you so much for watching. Once again, please click like, please click subscribe, please enable notifications. I appreciate you. I'm looking forward to seeing you in the next episode of Ignition Time. Take care. Bye.